A very important consideration in IHT planning is what happens when the business is sold or when you exit the business. And all our conversations with clients around IHT also talk to the fact of modelling out IHT positions through continuing the business growth and the share value increase, and also a position post-sale, in order to take a really holistic approach. But inevitably this sparks off lots of considerations around succession planning and also what the right position should be on a business sale or exit. So what are the most effective inheritance tax mitigation strategies for shareholders in owner-managed businesses? Well, there's actually a range of strategies that can be used, ranging from quite simple to quite complex. Now, the simplest strategy is just to give assets away. But clients often say to us, well, the problem is I don't know what I'm going to need, how much I should give away, I don't know what we're going to do when we sell the business, when we're going to sell, and what the shares are going to be worth. Now, this is a challenge, granted, and inheritance tax planning always involves an element of trying to predict the future, but I think one big message here is to try and guard against inertia, at least if you decide to do nothing ahead of the changes in April 2026. It should be a considered decision, not just a default position. And ultimately, when it comes to gifting, within reason, you might be better off doing something rather than nothing. Now, the key thing is to always take good advice before making any significant steps, particularly where there are significant values involved. There could be immediate tax consequences of getting it wrong. However, you might not be quite ready to go that far in relation to gifting your assets and shares for a variety of reasons, in which case it's likely that there might be some other strategies that might be more relevant to you, particularly revolving around retaining capital ownership or removing capital ownership out of your estate, but retaining control and access to income. Now, there are a range of possible options, but I think the most, in our experience, relevant ones revolve around use of trusts and also a vehicle called a family corporate. Now, both of these achieve essentially the same thing, which means transferring value out of your estate, but whilst retaining control over it. Now, trusts are well-established vehicles which are still very useful in circumstances, but there will be some limitations from April 2026, and there are some limitations in relation to the donors cannot benefit anyway from the trust in the future. So a family corporate is also a very flexible vehicle and has some key advantage over the trust, which is there's no limit to how much you can put into a family corporate, whereas gifts into trust do have limits. And properly structured family corporates can be a very effective way to minimise the tax cost on the sale of the company. And also, the original donor can continue to take an income from the family corporate if the setup is structured properly. Now, in practice, both vehicles have their uses and benefits. They're not exactly the same. So we often find that the effective strategy, certainly on larger estates, is to actually combine both. Now, there is another strategy we're talking to clients quite a lot about, and this also has an implication before April 2026, and this is one worth considering, and that is to buy out either wholly or partially maybe the senior shareholder or senior shareholders. Now, this might feel slightly counterintuitive because you're effectively putting money into the estate rather than taking value out of the estate, but there are a number of benefits if you can structure this correctly. The number one is, if we do this right, it will give the shareholder the security of capital rather than just giving away assets in terms of gifting. It also gives them the ability to draw down on this immediately, so it kind of allows them to take money off the table at a very attractive capital gains tax rate. It also caps their exposure to inheritance tax, as they are no longer receiving the growth in value, so you're capping the value of those shares as at today, and rather than getting the increase. And we can draw that down over time because we can use company funds to pay that out over a period rather than finding personal funds or having to pay that out all on day one. It's also worth mentioning that the entrepreneur's relief, now called BADR, if we do this transaction before April 2026, that rate will be 14%. That is increasing to 18%. So it's just another consideration. Now, there's no one perfect option, and there's no one way or the other. Every situation is different. The most important thing is to not leave it too late. These things do take time to implement, and we strongly recommend getting in touch. And our business and tax advisors are very experienced in helping businesses navigate these tax changes and help businesses through a whole journey of succession planning.